Many assets just follow the business cycle. I've got here the Russell 2000. That lives in ISM today. This weak economy is why we've got a weak Russell 2000. The Nasdaq lives in the future, which is why it's strong. There's no weirdness about the dichotomy between the cyclical companies and the secular trending ones. They always have this time lag. It's not some broken structure of the market or this is a bubble, that's a bubble. It's just normal. It's normal that the Russell 2000 lives in present day ISM. It's cyclical. So that's where that is. Crude oil. Same. Crude has been weak because the economy's been weak. Crude oil doesn't forward look the economy. What it does is it reflects the present state of the economy. Another way of seeing the economy as it is today is this chart, the number of states with decreasing coincident activity. So, number of states with bad economic data. It's very high. It's kind of in recession territories. When it crosses this 26 level, we're usually in a recession. Do we get a proper recession or not? Doesn't really matter, because a lot of that was priced in last year to the assets I care about, the forward-looking assets of crypto and tech, which I'll talk more about. But those of you who are small cap investors, emerging market investors, commodity investors, yeah, well, you're still at peak pain point, but it too shall pass. Next year. This is the bit that matters for everybody, particularly those of you who don't follow my exponential age thesis or my crypto thesis. But anyway, just so you understand, next year, well, here we start to see the economic indicators picking up. So the Empire and Philly Fed, the average of those is already showing an uptick. They're crossing that kind of zero level to say, hey, growth is about to come back. The ISM News orders minus inventories, this is a classic business cycle indicator, probably the most classic. It gives you a 3-month lead on ISM and it's screaming higher. It's telling us that the ISM is going to recover pretty sharply. And those recession fears, whether we get one or not, will be in the rearview mirror. Things will be getting stronger going forwards. And I know the last 18 months has been tough for many. Your portfolios and everything you owned got nuked in 2022. It's taken people's confidence away. I get it. Also, people have lost jobs. People's revenues have come down. It's not easy. But what I can tell you is 2024 is going to bring new sparks. The transition from macro spring into macro summer will take us from 2024 into 2025. Now, I know many of you are going to say, yeah, but what about employment? It's sticky. What about inflation? It's sticky. When's the cowbell coming? How's stimulus going to work? This next set of charts should help you understand that too. You see, it all goes back to these business cycle dominoes. The central banks are living in the past. What they look at is the current read on CPI and the current read on unemployment, not the forward-looking stuff. I'll show you the forward-looking stuff and you'll see how that's going to fold out into the headline, whether it's core CPI, headline CPI, and the unemployment numbers. You see, a lot of inflation is actually driven by the really lagging components of shelter and wages. These things lag between a year and 2 years, which is why coming out of a business cycle trough, disinflation continues for 18 months or so before rebounding. That's why central banks tend to be easing well after recession has ended, because they are living in a lag time horizon. They always do. It's bizarre, but that's how it is. If we look at core PCE and just look at the 6-month annualized change, this is here in the US. Well, here in the US, I'm in the Cayman Islands, but you know what I mean. That's already at 2.5% and falling. So it's showing that the inflation pulse is well behind us and stimulus becomes more likely. Even just using the base effects of core CPI year on year, we get to negative by the end of 2024. Do we get there or not? I don't know, but I think we're going to get very low and lower than the market expects, and that would be a surprise. It'll be a surprise on the upside of risk assets because it will mean more stimulus. And I think that's a really important thing. It also takes away the headwind from the economy. Now, obviously, we know with CPI, it's a bit of a con because those prices never come down. Even if we get a little bit of deflation of 1%, it doesn't make it easier for people. But hopefully, the offsetting rise in your portfolios will help somewhat. The other way of looking at PPI is taking out that really lagging shelter component, which that's not going to deflate for another year. It'll keep deflating for a year or so. But if we take that out, core inflation is already at 2%. Now, I know you can say, well, why do I care about, inflation that doesn't include my house? The point being is it's showing the trend. I'm not saying inflation's any less or you don't feel less pain. What I'm saying is all the other elements of inflation are coming down fast. But with this aging population, I think it's difficult. I do think unemployment will stay higher than expected over this cycle, but that's a function of less people in the workforce. And that's offset by the baby boomers who don't spend as much. Anyway, this CPI cycle is no different than all of the others. It's basically identical. It's this Mount Fuji pattern, up, down, and we should continue lower. Even that bounce is due to the year-on-year effects that we've seen recently, and we should continue over time to see CPI keep falling below the Fed's target. And when that happens, it drives asset prices. And if you look at the S&P versus the average trajectory of the last 12 episodes of inflation, it basically just goes up as soon as inflation peaks. And the S&P is just following the same pattern. Nothing unusual, should keep going up. But you can see that unemployment, this is this thing called the SAM rule, where it deviates from its rolling 12-month lows. When it rises 0.5% from that, it tends to lead to the Fed coming into action and a recession in play. We're kind of at those levels now. We backed off a bit last month. I think we'll get through that. And again, that may be the calling of the recession in Q4 this year, maybe even Q1 next year. Because even though the ISM is going to be bouncing out, GDP lags it by 3 months. So we'll kind of get that print later. So that's kind of how I see it from here. Now, to go back with that, once it comes off that 0.5%, what we see is the Fed cut rates every time. And again, I'm expecting Fed rate cuts in 2024. And I think not enough is priced in. Again, that's not consensus with the market. The market expects fewer rate cuts. I just see this as a normal cycle. And I've been through many, many cycles since 1990. And when the Fed cut, they keep cutting. And that's usually the path.